Check, everyone. Can somebody give me a audio check in the Discord or the YouTube chat? Great. Then we'll get started. Yeah, I'm sorry, I was speaking quietly. I apologize for that. I will be sure to speak up. Thank you. Hello, once again, everyone. I am Sensei Kevlar, and I'm here to talk to you today about predictive indicators. In the past, we've talked a little bit about lagging indicators, and one of the lagging indicators that I really like is the relative strength index, the RSI. The reason that a lagging indicator works is because it looks into the past and tries to tell us something about the past relative to the present. One of the ways in which these things work is that we're basically drawing programmatic trend lines. We're trying to use different types of analysis programmatically to draw these trend lines for us so we can see them very easily. Now, on some of these charts, this is really obvious, like a nice Neo chart on the 240 window here. You can really see where these trend lines are headed, and especially with a situation like this. Now, we've also already talked a little bit about predictive trend lines. I'm sorry, predictive indicators. Resistance and support are predictive indicators. And the reason that I say that is because what we're doing is we're looking at the past and we're trying to project that into the future to see where in the future we might predict this would turn around. This is an example of a predictive indicator. This is an example of a lagging indicator because we're saying that in the past this has happened, therefore this tells us something. And then we're using this lagging indicator to tell us something about the past and where we are relative to the past. And then we're using a predictive indicator to tell us where we might go in the future. So it's the combination of these two that really do form a good technical analysis. Now, there are additional ways of looking at this with regards to the technical analysis. There are patterns within charts that you can see that are very, very clear that kind of happen over and over and over again. And the reason that you can say that these things happen and that they become very clear is you go back and you study these charts. For instance, when I look at this chart, I see a pattern that I'm very familiar with. But that's because I know that pattern and I've studied that pattern and I've found that pattern over and over and over again in the market. So I'm going to start by showing you that pattern here and how you can use, when you see this pattern, when you see something that looks like this, you can use it to predict the future because it tells you where the market might go next. So let's start by taking a look at what happened previously in the market here. We were down at this level and then we got a lot of interest, a lot of big interest, and we came up and we found resistance here. And then we came back down and we found support at a previously correlated level, I'm almost positive. Let's go find out. We'll come in, we'll bring our horizontal ray in. Was this a previously correlated level? That was pretty close. It definitely did a little dip below it. You might even see that this is more interesting here. Somewhere in here, we can definitely have some predictions. They're not they're not terribly well correlated, but this isn't really the point. We came down, we did this little travel through here, and then we did this nice huge leg upward. Anytime you get this really nice huge leg upward, you're really looking for a nice big leg downward because that's what this is a good indicator of. When you go back in the past and you look at the market and you say, oh, the market went up and up and up, it's a pretty good prediction that the market's going to go down and down and down. The question is when, where, and how much. So let's take a look at what happened after we went up. We came up and we had a test of this resistance line right here, a second test of this resistance line, which we broke through but then got denied on, a third test of this resistance line, and then we came down and we started breaking down for real. What is this telling us? Well, this is 3 tops right here. 3 tests of a resistance line is a sign. This is something that happens over and over and over in the market again, especially when you see a really nice break above and then a lower break below. Now look at these 2 levels right here. These are fairly interestingly correlated. They're not exactly correlated, but if you touch the wicks of this one or the candles of this one, you do see that the market definitely had some pausing behaviors here. And if you look on a 1 hour chart, you might actually see a little bit more of those correlations happen, or you might see a little bit less. It depends. The point being is that this resistance line is very clearly a very strong resistance line in this market. So looking at this, and we can say that we did 3 tests, we came up, we broke through, got denied, came all the way back down. This is a pretty clear indicator that the market just doesn't like this price very much. We're taking too much profit, and when we get above, and then we get a bounce like this, and then we come back down, well, this is 2 tests right here, right? A single test, a double test, and then we broke through. Again, counting the number of taps on the ceiling or taps on the floor can add strength to a signal. Sometimes. Is that always true? Well, I don't know. Go back and test it. That's the point. Is it true in this market? Probably. Did it happen here, here, and here? Yeah, absolutely. Did it happen here, here, and here? Yeah, it did. Can we do this and can we go back and find this in other charts over and over and over again? Yeah, absolutely. What about on the reverse? Did it happen here, came through and broke above, and then we made a motion upward? Yes, it's true. Okay. Again, these are patterns that we can recognize to predict what we might do next. Back over here, looking more closely at this type of pattern right here, we can say that we made a very interesting set of motions here, almost like a head and a set of shoulders. If this were the head right here, I'm just going to draw this on with my pencil tool. If this were the head right here, these could be our shoulders on either side. Okay. And I'm just going to label those. That's our head. That's our left shoulder. That's our right shoulder. So let's take a closer look at this. Let's say that we saw this pattern again in the market. I'm going to get rid of these circles now that we've identified what the peaks that we're talking about and we've labeled them. Let's say that we saw this pattern again in the market, okay, where we saw one test, a higher test, and then a lower test of the market coming in at the same as our left shoulder. Would this be a pretty good indicator that we weren't going to make a bigger move upward, and that we might be setting up for this motion downward? Yeah, probably would be. What might that motion downward look like? Well, can we find out? What is the motion downward from here to here? Is it correlated? It's not bad. I'd say that motion absolutely happened. So when we measure this motion from this resistance line up to the left shoulder, and we're here in the market and we're seeing 1 tap, 2 tap, 3 tap, can we predict that we might make a motion downward? Yes. Can we predict that we might make a motion downward that might be similar to this one? Yes. Does that really happen in the market? Go back and look. Go back and find out. See if you can find the head and shoulders pattern in the market over and over and over again. And if you do, this may lend some strength of signal to your predictions. This might be a really good opportunity to sell right here, knowing that we're going to make, what is the motion we're going to make? That motion right there. Just take it, come over here and measure it. Where might I expect to come down to? Well, I know I could probably skip this one. I might even skip this one, knowing this measure right here. This would be my double up point, triple up point, quadruple up point. I could have doubled up and been profitable. Little bit, but a triple up would have made me profitable a lot sooner, and a quadruple up would have made me very profitable on this leg right here. Okay, if I had just bought one micro position and then come in 4x up here. Okay, now if I had been doubling up and doubling up, I would have tied up more of my portfolio, and I would have achieved the same result as if I had just 4x'd up down here. And this is planning for profitability. Why would I tie up my portfolio while the whole market is dropping and dropping and dropping if the market has already told me exactly how much it's going to come down? And if you think if I think I measured this ahead of time, I really didn't. I can just go do this on any chart. This really does happen over and over and over in the market again. This happens so often in the market that they make a tool for it. It's called the Head and Shoulders tool. And it is right here. So the way the Head and Shoulders tool is you identify where the start of the head of the left shoulder begins, and you click, and you come up, touch the tip of the left shoulder, down to the bottom here, come up and make the head, come on back down, come up and touch your right shoulder, and then where can we go from here? Just go ahead and pull that trend line on down. My computer doesn't lock up right now. And then as soon as you're done pulling that trend line down, lock it into place. What you're trying to see is do we actually have a strong correlation along this? Does this make sense from this? Okay. Now, in this case, what this head and shoulders is telling us is that it might not make nearly as much sense. There's definitely an upward trend that is causing this head and shoulders to have a real upward shrug to it, okay? But let's imagine for just 1 second that this head and shoulders had presented itself a little bit differently. What would have happened if instead after the head we had come all the way down and met the left shoulder's lowest low right here? Okay, what would be different? What would this change about this indicator? Look at the difference in what the indicator is telling us. If we really had come all the way down here, where could we have known to drag this indicator down to? The same line that we touched it on, okay? So, when we draw our indicator correctly, our indicator actually told us exactly where we could expect it to come back down to, because look at where it came back down to over here. And did the market do this? Yes. This is a nice predictive indicator because when this pattern presents itself in a uniform fashion, the indicator will present the prediction in a uniform fashion. And when it presents itself in a slumped fashion, you might expect that it could take longer to run out, or it might not come down as far. You might expect that it comes down here and you might be a little bit more cautious about your entry right here, or you might be a little bit more aggressive depending upon how you test this indicator to tell you what the market is going to do. This is a really good predictive indicator in situations where you have a good amount of market volatility to match your opportunities with. Because when you see this triple test, when you see a triple test of top, when you see a triple test of bottom, you want to be able to say, where can we go from here? And do that with some reliability, such that you can say, well, obviously, if I have a really nice leg here, I think I'm probably going to skip the first part of this leg here and go for the longer leg. And that would have ended up being the right move for you. So could this have been skipped, and could this have been our first double or triple up with a second double or triple up right here on the new on the original resistance line, which became support? Absolutely. Did that work out for us long term, even if we did not get the exit here off of the double up or the triple up, because it came up and it just denied us the double up exit, but it would have given us the triple up exit? Yeah, it did. Here's our opportunity. If you had waited this one out, this is the plan right here. This is what we originally said. This is what we were going to do. Is if it came down to here, this was our first double up opportunity, because this is where it came down to over here. If it came down to here, this is our second double up opportunity or triple up opportunity, because this is where we previously were in the market. All these other endpoints, not nearly as interesting, not nearly as well correlated by our predictive indicators. This predictive indicator absolutely told me where my second line was and my first line. It's right here. It's these guys. It's these ones which are correlated in the market. So even if we're in this leg, even if this is already presenting itself, can we sell up here and still make a big profit opportunity for ourselves? Big time. This is a classic way to see a market and go, oh look, I could absolutely sell even in a downtrend, even when we're moving down, even right here, and still make a profit opportunity for myself when I get down to here and then go upward again. Because buying, just keep on buying and buying at the correct positions for myself, at the plan that my plan allows me to, at the plan that my portfolio allows me to, at the plan that has been supported previously by the market, you combine all of these things together to make a plan that really does keep you profitable. And I really do want to stress this because these markets do this. You have to be so prepared that previously you were looking at this chart and you thought everything was, expando grando, and then you come in somewhere and then this happens. And you're like, oh, this is great. This is fantastic. The market's going to go up forever. So you keep on trading this opportunity. Why? Because you're profitable up here, so you buy in here. And then you're profitable up here, so you buy in here. So, you're profitable up here, so you buy in right here. Why wouldn't you? It's what you've always done. And then the market takes an absolute crap on you, right? Now, if you pull this out, could you have done more analysis that would have stopped you from buying in here when you saw the 3 tests of the top? When you saw the head and shoulders forming? When you saw volatility being, the trend lines being triple overbought here and then overbought again, oversold here and oversold again? Could you have predicted that the market was probably ready after all of this action to take a turn back down and then gone ahead and skipped this opportunity in order to wait for this one down here and then this one down here where we are right now? Yeah, you really could have. And if you look, I drew this line a couple days ago. I drew this line back on the 30th, right? It's now the 1st. Coming down, going up like this, we're creating opportunity for ourselves across the board. If I had sold here, I could double up or triple up right about here on my I can just buy it all back right here. Okay, if I was to buy right here, this would be really easy to take advantage of. This is an easy market to do, and especially when you have volatility that's starting to ramp up and volume that's starting to ramp up, this is a great one to find. Other predictive indicators that I really like a lot are, for example, the trend line, right? Here we have a couple of trends coming in, and we can see that this is experiencing contraction. These things are coming closer together as we move. This is a sign that the market is getting ready for a change in direction. The forces that have been pushing this downward have basically lost their Peter, and right about here, you see that the market really came up. Well, where's our Williams indicator? Can we predict that we're about to move up? It's the CM Williams finds market's bottoms. Can we predict that we've had a slump and the market does not like this price it is not really interested in it at this price, but is more interested at it at this price? Is this a prediction? Yes, absolutely a prediction. What we want to do is we really want to be honest with ourselves and take something like this and say, or even better, bring it up to this guy right here and say, this is the really clear sign that we're going to break out, right? Is when we get above this thing, when this trend line breaks above this blue line, that's really going to be the clear sign that we're going to move up. But can we plan for profitability even prior to that? Absolutely. Look at how much further off of the uninteresting volume this is down here. We're already above that. Is this our really strong signal to start getting serious about buying and doing our entry? Sure. Can we come down to here? Yeah, be prepared. Get real prepared. Find your true market bottom. This is where your real next entry is, down here. If we start really plummeting at if we really do continue this, right? But what I'm looking for is I'm looking for this to tell me that we really can go up soon. I'm looking for 1, 2, 3 tests of a bottom. Do we have it? Yes, we do. especially on a running out trend line. We're moving off of the trend line. So I can just keep on building a case for this and building a case for this. But I don't want to build a case for this in real time. What I want to do is I want to build a case for this historically, and then use my historical information to try and predict what the market is going to do next. Let's take a look at where we are right here. We're going up, and then we have a huge spike upwards. Can I predict that the market is going to go down from here? Yep. Probably could have even been profitable on this leg of the trade right here. Could I have done it even more? Absolutely. Bring in the RSI, bring in your other predictive indicators. Can we find any interesting patterns on this? Well, I think we can find probably a few tests of the bottom. Here's a couple tests of the bottom. Let's pull in a different chart. Do the BTC USD. Here's 1, 2, 3 tests before we got denied. Then we were able to do the climb back up. Then we did 1, 2, 3 before we got denied. See if we can spot a head and a really clear, it's a pretty clear head and shoulders right there. Okay, let's do that one. Take from the lowest low, come up to the left shoulder, small left shoulder, bring it on down to where the wick really came down to. Head, wick, right shoulder. Where are we going to come down to? Same place we were down here when it lines up. Okay, let's say that we're seeing this right here. We're seeing this in the market. We identify that there's a left shoulder and a head, and we're now here, and the market's starting to break down on us. Does this indicator predict that we can move down to here on the head and shoulders pattern? Absolutely. Does it mean we're always going to? No, it could mean that we're going to bounce off of right here and then go to the moon. Happens all the time. How often it happens in this market historically is the strength of the indicator. If half the time the head and shoulders sets up and then it goes to the moon, and half the time this head and shoulders sets up and then it goes exactly where you think it's going to, it's not a very strong indicator. But if 90% of the time, if 4 out of 5 times, 80% of the time, if 9 out of 10 times, 90% of the time, this happens, then it's a fairly certain indicator. It can add to it. Nothing is ever certain. You can always be wrong about it. A pattern can always fail to present or fail to follow through. That's not something that you can count on, but it is something that can help you see where we might go next. In this head and shoulders, now that I've drawn the head and shoulders, I almost can't stop seeing it. And it's once we recognize these patterns. Now, is this actually happening on a larger time frame? Could be. Pull it out to a larger time frame. See if there's not a second head and shoulders forming within this head and shoulders. Find the patterns within the patterns. Find the different indicators that tell you where things are going to go. Now, sometimes, before I use the head and shoulders to measure the length of a possible motion, a possible future motion, by measuring the length of a previous motion. Now, support and resistance indicators can really tell you a lot, but there's something that's even more interesting about these correlations that happen in the market, and that's that there are lots of different ratios that happen. For instance, the golden ratio. The golden ratio forms from the Fibonacci sequence. The Fibonacci sequence forms when you take the previous number in the sequence and add it to, or the previous two numbers in the sequence and add them together. So you start with 1, you go 1, 1, 2, 3, 5, And then on is 7, 9, 13. Each time you're adding the previous two numbers in order to derive the next number. Now, when you take any two numbers within that sequence, and then you take any number and you divide it by the next number, that's a 1.618 ratio, and that normalizes out to a 1.618 ratio the further out into the sequence you get. And if you take the previous, if you divide that number by the previous number, that comes out to 0.618, which is the golden ratio. So the reason that these things happen is because price movements tend to stay within one standard deviation. Let's pull up what a standard deviation is using the bell curve. Good old standard deviation graph. The idea is that given previous price motions, we know that our future price motions will likely be within some predictable range, and that predictable range always happens to fall along a very predictable curve. Here is 34 plus 34 is 68.2%, okay, which again is the 6.1 is the 1.618 ratio falling within a standard deviation. So if a price were to make a motion, it would generally stay within 68% of that motion for most of the time, and then for the rest of the time, for 68% of the time, and then for 98%, for 95% of the time, again, that's 34 plus 34 plus 13 plus 13 on either side. That's this range right here. This forms our second standard deviation. 95% of the time, any price motion within up or down is going to be within one or two standard deviations. Within one standard deviation, 68% of the time. Within two standard deviations, 95% of the time. Okay, so that 95%, that means that you're at it's going to be outside of that range 5% of the time measured in the past. So let's see if we can actually find those ratios of price motions against each other. Well, what we can do is we can take this, and we're just going to measure this length right here, and then we're going to measure it against this length right here. Okay. What we're looking at is if this were, I'd use the wrong tool to do this. Let me do this again. Do the Fibonacci retracement. There we go. We're going to measure 100% of our motion right here, okay? And then what we're going to say is that any future motions that happen after this motion are going to happen within one standard deviation 68% of the time, and within two standard deviations 95% of the time. Okay, where's one standard deviation? It's right here. That's the 6.18%. So what we're saying is 68% of our price motion is going to be in this range right here, and 95% of our price motion is going to be in this range right here. Okay, so look at this line right here. Here's the 6.18 line, the golden ratio, right on the mean. After we made this price motion upward, were we able to make a 6.18 retracement? Were we able to come back down 61.8% of the original motion? That would be this line right here. Yes, we were. Turns out that these types of predictive price motions, where if this is 100% of the motion, then this is 61.8% of the motion, will happen 61.8% of the time. And these motions, which will happen all the way down to here, down to the 7.86 78.6 will happen 78.6% of the time, all the way down into here, into the 95% ratio right here, okay? These are incredibly well correlated numbers in the market. Look at the halving of the 6.18%. That's the 38.2 as the 38.2% mark. Did we do a motion that was half of the golden ratio of our original motion? Yes, we did. It was right here. Here's 31.8% of the original motion. Here's our 38.2% of the original motion. Here is 61.8% of the original motion. If we knew that we had taken a really big stretch upward, could we have used a predictive indicator just to completely guess? We measure from the bottom to the top of this really huge motion. Could we have guessed that it might come down to the 38.2 mark? Could we have guessed that it might come down to the 61.8 mark? Yes, 38% of the time and 61% of the time. I'm sorry, excuse me, other way around. 61% of the time and 38% of the time, we absolutely can expect that would happen. We can expect that this will happen 61% of the time. We can expect that this will happen 38% of the time. We can expect that this will happen 23% of the time, etc., etc., etc. We can plan for the statistics of this model coming through and supporting our case. If we say we predicted it was going to come down here, can we later predict it's going to make that motion again against that same amount right there? Absolutely. These are predictions that can add to these, add to it here, okay? Now, is that true in reverse? If we make a motion upward and then downward, might we make a motion relative to this upward again? Absolutely, happens all the time. Let's see if we can find it. Okay. Again, what we're going to do is we're going to measure the bottom of our motion to the top of our motion, and then what we're going to do is we're going to bring that down, and we're going to reset where that motion might start. Okay. If we were to say that we expect this motion to happen again, but we were expecting it to start down here, where if we were to take, let me just draw it in so I can really make this clear here. If I were to take from here to here, this original motion that we're measuring right here, and I say, how tall is this? And then I say, well, if I think I can make this motion again, but I want to start this motion from right here, where are we going to go to? It's going to go to right here, the 100% mark, and then where are our correlated action points in the market? Okay, let's say that we're here in the market. Let's drag the chart forward. We're here in the market. We've come down and we've made a new lower low, and we want to be predictive about where we might go up to. We can take our Fibonacci retracement, bring it up to the high and down to the low. Then what we're going to do is we're going to measure this motion again, starting at this line right here where we came down to. Where might that take us? That's the 100%. If we were to make this motion again, this would be the 100% mark. This would be the 1.618. This would be 100% plus 61.8%. This would be everything in between. Here is our 6.18%. Here's our 3.28%. Did we do motions within standard deviations? Yeah, right here. This is within a standard deviation. This is within a standard deviation. This is where we predicted that if we were to remake this motion again, that this might be where we stop. Did we see turnarounds at the golden ratios? Absolutely. These predicted our resistance lines before we knew them. We knew that the resistance line was going to be here without having a resistance line to bring in. How? Because what we did is we took this motion right here and we measured it. And we said if this motion were to happen again, but we were to do it again starting at the bottom of the market, which is down here, where would that take us to? That would be our new resistance line. We predicted what the next resistance line would be without having any prior resistance line. This is a market peak. We've never been this high before. There is no way I could have predicted that the market might pause and turn around by looking backwards in the market and looking for a previous resistance line. I needed to be able to take this, measure it, bring it in here, and see where it might go. Would this have been a really good, strong place to sell? Yes. Why is this happening over and over again? Because other traders are looking at this. Other traders are using these tools. Other traders are expecting turnarounds within the standard deviation. Other traders are expecting that previous correlations in the market will tell them about future correlations that they can predict. Other traders are setting their bots at these levels. Other traders are saying, I'm going to take my profit at these levels because I don't believe that the market can go any higher based upon having measured my previous motion right here. This would be that motion again. We have now done that motion twice. Can we make that motion a third time? Let's look at our trend lines. Our volume trend line tells us we're really not prepared to make that motion again. The market has become decreasingly interested in this price level. It was much more interested in buying things up at this price level. It has become decreasingly disinterested at this price level. This would be a really good place to become neutral in the market, to take your profits and get out, right? Or if you had been selling for a while now, to look for a place to start buying back in, because this is a huge opportunity for profits. And it's also a huge opportunity for this to turn right back around on you and come all the way back down to here, all the way down to the 4,000 mark. I'd say that is absolutely a strong possibility and something you really absolutely need to plan for in every way, shape, and form. So, when it's coming back down, where might we predict that it could turn around? Well, obviously, right here, right here, right here, right here, right here, and right here. These are the most obvious predictions that the other traders are going to make because they're looking at it and they're going, well, it already turned around right there. Look at it bounce off of those programmatic trend lines. I didn't have to draw the support and resistance line. All I did was I took my Fibonacci retracement tool, the trend-based Fibonacci extension, because I'm doing an extension here, and I'm saying I want to go from here to here and then extend that out. I'm just going to extend that out into the future. And I'm saying I want to extend this motion. I want to take this motion and I want to extend it. If I want to see where it can come down to, I wouldn't use a trend-based Fibonacci extension. I'd use a Fibonacci retracement to see where it could come down to. I'm just going to take it to here, and then I'm going to extend it over here. All I did was measure this motion. That's it. With one tool, I measured a single market motion and programmatically predicted my support and resistance levels. I can get rid of these blue lines right here. I don't need to draw these anymore. Now my Fibonacci tool draws my lines for me, simply by measuring the motion right here. These are predictive indicators. And using predictive indicators and mastering the patterns and being able to see where things are going to go in the market by understanding why the patterns work. These patterns work because they are based on standard deviations, because they are based on percentages of the original motion, because other traders are looking for these standard deviations. They are looking for motions that will always happen within this bell curve. They're going to happen 68% of the time. It's going to be within this range 95% of the time. If it's going to be within this range 95% of the time, can we plan for it to be in this range 95% of the time? Can that be incorporated into our plan? Can we do the math, working out the 5% on the times that we're wrong and how far we need to go down on that 5% times that we're wrong? Yeah, that's called planning for profitability. And when you plan for profitability, when you fundamentally understand why the market is making the motions that it's doing, why the trend lines form the way they do, then you can start to bring in more tools. Then you can start to bring in more intelligence. Then you can start to bring in more indicators. And this is where this gets really interesting, because can we start to read this market like a book? It does. It really starts to tell us a story that we can just automatically tell ourselves, right? Is when the market is when we're here, we can pretty safely knowing what we're going to do next. We're going to be profitable up here. Absolutely. In fact, we're going to be profitable if we're smart. We're going to be profitable once here, again here, and maybe hold out till here, right? But only if we have a good predictor on this. Could we have predicted this motion based upon the previous one? This is where the real magic happens. Let's do that Fibonacci extension. All the way down to all the way up, and bring it on over. Well, turns out this came in right at the 200 and golden ratio number. What a heck of a run. Look at where the 100% of that motion fell. Again, what I'm doing is I'm measuring from down here. Let me get this out of the way so you can see a little bit better. I even got this off a little. I could grab you. Thank you. There we go. Yeah. Came in right close. There it is right there. If I did this motion to this bottom to this top, and then I was here in the market, okay, this is what happens. So I'm here, and I'm here, and then I come down to here, and I'm here in the market. Where can I predict I might go to? Well, I don't have any new or any historical trend lines, any historical resistance lines to tell me. So what I can do is I can measure from the bottom of here to the top of here, from the bottom of this motion to the top of this motion, and then I can bring it on over here, and that's 100% of that motion again. What would be the golden ratio of that 100% plus the golden ratio? It would be that number right there. What would be 200% plus the golden ratio? Well, let's find out. We coming up on it? You think this might be a target for a lot of people? I think we're in a danger zone up here. Predictive. We can absolutely predict where the market really has to turn around, because everybody has to be looking at this and going, so you can get, Fibonacci on top of Fibonacci on top of Fibonacci, and ultimately, at the end of the day, they can all be wrong. But we can plan to be wrong, and we can plan how often they are wrong by going back, looking in the market, finding that they are correlated, and building out a strategy that has us profitable even when everything is going terribly wrong for us. And market can be going up and we're profitable, market can be going down and we're profitable. And this is the way of the trader. Thank you everyone for your time.